Hey everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we are diving into one of the most important forces shaping global markets right now, and that is the dollar strength impact markets dynamic. If you've ever wondered why commodities suddenly drop, why international stocks lag behind US equities, or why crypto struggles during certain periods, there's a good chance the strength of the US dollar is playing a major role behind the scenes. So, in this episode, we are going to take a deep, detailed look at what a strong dollar really means, what drives it, and how it affects everything from commodities and stocks to bonds, crypto, and global trade. And more importantly, we'll talk about how you, as a trader or investor, can actually use this understanding. Let's get into it. First, let's define what we mean by a strong dollar. When we say the dollar is strong, we simply mean it's increasing in value relative to other currencies. So the US dollar buys more euros, more yen, more pounds than it did before. Now, that might sound like a narrow currency concept, but it's not. Because the US dollar sits at the center of the global financial system, its strength has ripple effects everywhere. And there are a few main drivers behind dollar strength that you need to understand. The first is interest rate differentials. When US interest rates rise compared to other countries, investors naturally want to move capital into dollar denominated assets like US Treasury bonds. Higher yields attract global money, and that demand pushes the dollar higher. The second is economic performance. If the US economy is growing faster or appears more stable than others, capital flows into US stocks and businesses. Again, more demand for dollars. Third, safe haven demand. In times of uncertainty, whether that's geopolitical tension, financial instability, or sudden shocks, investors look for safety. And the dollar is still seen as one of the safest, most liquid assets in the world. And finally, expectations around monetary policy. Sometimes the dollar strengthens not because of what the Federal Reserve has done, but because of what markets expect it will do. Even the anticipation of rate hikes can move the currency. Now, here's where it gets really important. The reason the dollar strength impact markets effect is so powerful is because the dollar isn't just another currency. It's deeply embedded in how the global system works. Most commodities are priced in dollars. A huge portion of global trade is conducted in dollars. And many countries and corporations borrow in dollars. So when the dollar moves, it doesn't just affect exchange rates. It changes pricing, demand, liquidity, and capital flows across the entire global economy. Let's start with commodities, because this is where the relationship is most clear. Commodities like oil, gold, copper, and agricultural products are priced in US dollars. So when the dollar strengthens, those commodities become more expensive for buyers using other currencies. Think about it like this. If oil is priced at $80 per barrel, and the dollar strengthens against the euro, European buyers now need more euros to buy that same barrel of oil. That increase in cost reduces demand. And when demand falls, prices tend to follow. This is why we often see an inverse relationship between the dollar and commodity prices. When the dollar rises, commodities tend to struggle. Now, it's not always perfect. Supply shocks, geopolitical tensions, or production cuts can override this relationship. But over time, the dollar remains one of the most consistent macro drivers of commodity markets. Gold is a particularly interesting case. It's not just a commodity, it's also a monetary asset. When the dollar strengthens and real interest rates rise, gold often comes under pressure because it doesn't generate yield. So that's commodities. Now let's move to equities, where things get a bit more nuanced. Within the US stock market, a strong dollar creates both winners and losers. Large multinational companies often face headwinds. Why? Because they earn a significant portion of their revenue overseas. When those earnings are converted back into dollars, they shrink if the dollar is stronger. On top of that, their exports become more expensive, making them less competitive globally. So even if the business itself is performing well, currency effects alone can reduce earnings. On the other hand, companies that are more domestically focused can actually benefit. They rely less on foreign revenue, and they can take advantage of cheaper imports and stronger domestic purchasing power. Now, outside the US, the story shifts again. A strong dollar often pulls capital into US markets and away from international equities. At the same time, local currencies weaken, which can reduce returns for global investors. So overall, dollar strength tends to favor US assets and put pressure on international markets. This is a key part of the dollar strength impact market story. It doesn't just move markets up or down, it reshapes leadership within them. Next, let's talk about bonds and global liquidity. When US interest rates rise, US bonds become more attractive. That draws in global capital, increases demand for dollars, and reinforces the strength of the currency. But this has serious implications for emerging markets. Many emerging economies borrow in US dollars. So when the dollar strengthens, their debt becomes more expensive to service. At the same time, their local currencies often weaken, making the situation even worse. This can tighten financial conditions significantly and, in extreme cases, lead to financial crises. There's also a broader liquidity effect. A strong dollar tends to drain liquidity from the global system. When capital flows into the US, there's less available elsewhere. That means higher borrowing costs, reduced investment, and slower growth globally. This is one of the most important, and often overlooked, aspects of dollar strength. Now let's bring crypto into the conversation. Cryptocurrencies are highly sensitive to liquidity and risk appetite. When the dollar strengthens, liquidity tightens, and investors tend to move towards safer assets. That usually puts pressure on crypto. On the flip side, when the dollar weakens, liquidity expands, and capital flows into riskier assets. That's often when we see strong crypto rallies. There's also a psychological component. A rising dollar often signals caution in markets. And when traders are cautious, they are less likely to allocate heavily to volatile assets like crypto. So again, the dollar is acting as both a driver and a signal. Now let's zoom out to global trade. A strong dollar makes US exports more expensive, which can reduce demand for American goods overseas. At the same time, imports become cheaper, which benefits consumers but can widen trade deficits. Companies often respond by adjusting pricing, shifting supply chains, or rethinking where they produce goods. Over time, these adjustments can reshape global trade patterns. There's also a link between dollar strength and inflation. When the dollar is strong, imports are cheaper. That can help reduce inflationary pressure, especially in areas like energy and consumer goods. And that feeds back into monetary policy decisions. Central banks, especially the Federal Reserve, pay close attention to currency strength. A strong dollar can influence interest rate decisions and create divergence between economies. Finally, we need to talk about the dollar's role as a safe haven. During times of uncertainty, whether it's financial crises, geopolitical conflict, or sudden economic shocks, investors tend to move into the dollar. That pushes the currency higher and often coincides with declines in risk assets like equities and crypto. So when you see the dollar rising sharply, it's often a signal that markets are moving into a risk-off environment. Now, what does all of this mean for you as a trader or investor? First, it means you should be watching the dollar closely. The dollar index, or DXY, is a key benchmark. Second, pay attention to interest rates and Federal Reserve policy. These are major drivers of currency movement. Third, think about asset allocation. In a strong dollar environment, US assets and defensive sectors often perform better. In a weaker dollar environment, commodities and international equities may have more upside. And most importantly, stay flexible. Currency cycles can last for years, but they do change. If you want to actually trade these macro dynamics effectively, having the right tools makes a big difference. If you're looking for a world-class, cutting-edge, user-friendly trading platform app, you can check this out. crystalballmarkets.com/platform. It's designed to help you track markets, analyze trends, and act quickly when opportunities appear. And if you're still learning or want to deepen your understanding of trading, investing, and macro, I highly recommend building that habit consistently. You can explore beginner-friendly podcasts covering trading, investing, macro, and financial markets right here. rss.com/podcast/crystal markets. It's a great way to stay informed and keep improving over time. So to wrap this up, the US dollar isn't just another currency. It's one of the most powerful forces in global finance. From commodities and stocks to bonds, crypto, and global trade, the dollar strength impact markets relationship touches everything. If you understand how and why the dollar moves, you start to see the bigger picture. You stop reacting to isolated price moves and start understanding the forces driving them. And that's where real trading insight comes from. Thanks for listening, and I'll see you in the next episode of Financial Market Insights for Traders.